Kenya's private sector, the engine of the country's 37 billion economy, is said to be large by sub-Saharan African standards. This was a key highlight in a recent report on the state of Kenya's private sector. Being well diversified, East Africa's biggest economy has weathered external shocks such as the 2008 global financial crisis.
If we have a strong private sector, we must have a strong government to balance. If it is lopsided, then it's not going to be acceptable. If you think you have a contract that you signed 10 years ago that is lopsided against the people of Kenya, I will not recognize it.
It's a good news story insofar as we discovered that the Kenyan private sector is in good health. It is vibrant, it's very entrepreneurial. The downside is that there are some recurrent challenges. So there are some persistent challenges which the private sector is facing, which is preventing it from reaching its full potential. So if those are removed, Kenya will really stand to reap some great dividends from the perspective of a growing and successful private sector.
While public sector output remained relatively static in the past decade and a half, the private sector has increased by 68% in the same period. However, 9 out of 10 workers in the private sector are employed in the informal segment, which is a worrying trend for experts.
It's an irony. It is really a tale of two economies, in a formal and an informal sector. A formal sector that captures maybe 2% of the thing. Perhaps, of course, in volume it's very high, as you can imagine, because most of the big taxpayers and so on are in that. But a large informal, I think it's called Gachenge in this country, that employs 90% of people employed in the private sector are found there. Now, we need to better understand these dynamics, because there's a reason, there's a very good reason why people decide to be in the informal sector. It's because maybe they don't see any value from paying their taxes and not getting enough services from government, not enough protection.
Traditionally, this happens especially when you've got a formal sector that's relatively well developed and sophisticated, and so they struggle then to interact with, especially from a supply chain perspective, with small players who don't adequately understand issues around reliability, consistency of quality, ability to manage cash flow. So quite frequently there are those natural impediments to interaction. There have been a number of small programs that I believe have been developed over time to try and address this, but the success of that is yet to be better understood.
I think people don't remain informal out of choice. They are, everybody wants to, set up a thriving business that is growing to become an intra-Africa or multinational for that matter. And the truth of the matter is many of the multinational big companies today were at one stage small businesses. What I think has been challenging some of our small businesses has been access to finance for growth. That is a big issue. We need to make sure as government we try and formulate a system to enable people to access finance in a manner that can enable them to growth. And government has already taken a step to make some commitments around the Uwezo Fund, around the Youth Fund, the Women Fund, the small enterprise support mechanisms. The second most important issue is access to markets. You can manufacture things, produce things, but access to market is an issue. That is why the government has made a commitment that over 30% of public procurement will be dedicated and preserved for the small and medium-sized businesses.
Manufacturing, which contributes about 11% to the gross domestic product, has however remained largely stagnant over the years. The sector is a key pillar targeted in Kenya's economic blueprint, expected to lead the country to double-digit growth by Vision 2030. The poor performance in the manufacturing sector has an adverse effect on the health of the economy.
The manufacturing sector depends on some inputs which are significant for them to succeed. So the first one is energy. Energy, in some cases, contributes as much as 40% of cost of production for some of these players in the industry. When people produce goods, for them to actually transport, infrastructure is another serious issue. These are things that we have as a country lagged behind for a very long time. And it's not lagging behind by some percentages or things like that. We have lagged behind in multiples. The cost of energy in Kenya is 3, 4, 5 times, in some cases, as expensive as it is in countries where some of our investors have opportunity to invest in. So these are things that have really pulled down investors. What we have seen is a number of industries that have failed precisely for that reason. To attract new ones, we must prepare the ground to make Kenya a competitive destination to attract companies to come and invest in the manufacturing sector.
If you don't grow your productive sector, you cannot employ many people. What ends up happening is that you just become a retailer. Because people, you know, if it's a question of food, for instance, if we like nice yogurt, or if you like nice flour, I mean, whatever it is, if you cannot produce it in Kenya, we will import it from somewhere. So you'll have a very vibrant, growing service sector and retail sector, but those are very low quality, low paying jobs. So if you need to transform this economy, pay people sufficiently to be able to demand, command a much higher demand within the economy, signify demand within the economy, you need growth of industries if you're going to export. And one of this report didn't capture it, but the growth of exports coming out of Kenya has been declining compared to even our region, our brothers in the region. Growth of exports in Uganda is 14%, Tanzania the same, Kenya 6%.
While the private sector contributes 2/3 to the GDP, underpinning its significance to the Kenyan economy, access to affordable finance has, however, halted its growth. The sector contracted to 3.1% last year compared to 3.5% in 2011.
There's a very robust private sector in Kenya. There's a robust money market, capital market in Kenya. But still, access to credit is very constrained. It is expensive. The access is limited to those that can. So,
despite the strides made in enhancing Kenya's business climate, the private sector report recommended government to fast-track infrastructure development, which is critical in reducing the cost of doing business in the country.